My name is Jake. Welcome to the channel. In today's video, we're going to talk about a lot of stuff. I want to give a lot of updates on what I've been doing with my cash flow portfolio here. If you follow my channel, I share the majority of my videos on my cash flow portfolio. In my most recent video, I spoke about the real estate portfolio that I have here, kind of going through some of the changes that I've made here, some of the changes that have been impacting me in my personal life. For the most part, all positive, right? For those of you that watched the last video, I recently started a new job, a new position in a new company. By doing that, I was able to increase my earned income. And so hopefully by that, I'm going to be investing more into my portfolio. I've been also investing a lot of time in investing into rental properties. And my wife and I, we purchased our first home last year, our first rental property as well, the end of last year. And we're going to be purchasing a new home here in the next coming months. And then we're going to move out of our current home and then rent out this home. So kind of been doing that for the last couple of months. And the reason why is we really want to turbocharge our returns. Our goal is to reach financial freedom here in the next 15 years or so. I mean, if it's sooner, okay, great. But I don't want to get too overexcited. We're setting a goal here in the next 15 years to reach early retirement. So in today's video, I want to talk about a lot of stuff. I want to talk about updates that I've made to the portfolio. I haven't gone into the cash flow portfolio here in quite some time. So I want to give a detailed overview of what I've done, some of the things that I've changed, updated. And then really what I'm most excited about towards the end of the video, I want to talk about the dividend tracker from Dividend.com. It's called PROPELOR. We'll take a look at that. I'm going to walk everybody through the sign up process, transferring over your portfolio. Spoiler alert, you can actually now transfer over automated your M1 portfolio into PROPELOR. Before, if you were a dividend investor using M1 Finance, it was very difficult to make transfers or to automate this process into trackers. And now I'm really excited to say that you can do that. They have an API, an application programming interface, where you can integrate your portfolio, your M1 Finance portfolio, seamlessly into PROPELOR's dividend tracker. So stay tuned to that. I'm going to walk everybody through that process from start to finish. Okay, first off, so if you're new to the channel, I'd invite you to subscribe. I talk about dividend growth investing, and in every video is really focused on new or beginner investors. And when I first heard about M1 Finance, I was currently using Robinhood, Vanguard, and TD Ameritrade. I was using different brokerages. And when I heard about M1 Finance, I initially signed up. I think I deposited like $1,000 and was just going to try it out. And I was a little bit skeptical when I first was doing my research, like you're probably doing right now. I was watching YouTube videos from other people. This was back in, I think, of March of last year, and just kind of doing my own due diligence research. And then after about a month or so of using M1 Finance, what I decided to do was transfer over my portfolio the middle of May from my Robinhood account to my M1 Finance portfolio here. And what I've done is, ever since then, I've dollar cost averaged into my portfolio. One of the cool things that I love about M1 Finance is you can set up automatic transfers, and it will transfer over into your portfolio, and then through M1 Finance's dynamic rebalancing, it would automatically invest into your underweight holdings. And so I've done that for the last year. And we've seen ups and downs in the market here, the last couple of months. But regardless of that, I've continued to dollar cost average into my portfolio. And that's really the investing approach that I have, is dollar cost averaging. I'm picking high quality companies that, regardless if they go down, I feel comfortable putting more money, doubling down, I guess you could say, into these investments and really being able to sleep at night. That's been really important to me with this investing strategy, is I want to be able to sleep at night. I don't want to be, going crazy about buying low and then selling high and missing the boat, all of that good stuff. I have a slow and steady approach to my investing strategy. Okay, and so over the last couple of months now, I've been doing a lot of thinking about my own portfolio, my own circumstance where I'm at. As I mentioned earlier, my wife and I were looking to retire in 15 years. We want to live off of the earned income from our portfolio and our rental investment properties, the cash flow from that. And so over the last couple of months, when we've seen the market go down 20, 30%, and seeing my investments, some of them have cut their dividend, and it really has caused me to think, okay, is this strategy viable? If we were to fast forward 15 years, would I be able to stomach my portfolio going down 30%, like many people are currently experiencing? Right now, I'm pretty early in my stages. I've been doing this for a year. I've been investing for over 10 years, but haven't really stayed consistent with one type of strategy. I've invested in penny stocks. I've invested on margin. I've lost a lot. I've made a lot. And it just hasn't given the returns. Like, I haven't been able to beat average market returns if, just looking at the S&P 500. I've been trying to time the market in the past. It just didn't work. And the stress with that, it just didn't work for me. And so I've been doing this consistently for a little over a year now. And I've seen that this is working for me. And if I were to fast forward 15 years from now, okay, if I was solely relying on my dividends and my rental income, I need to make sure that my investments are secure and that they're safe, right? And that I'm not investing into companies that are on the brink of bankruptcy or that are going to cut their dividend or suspend their dividend. So I really want to safeguard my portfolio. And so a lot of the changes that I've made or updates to the portfolio that I've made with that in mind. A lot of the companies that I hold in my portfolio, I feel confident about them, but I want to update everyone on how I currently have my portfolio set up. I want to talk about the target allocation. I want to talk about how why I'm investing more into certain companies and less in others. And it's going to be really exciting. I think a lot of you are going to look at some of the updates that I've made and think, okay, that makes sense. I think a lot of you watching the video here are going to be like, okay, well, why is he doing that? That's kind of stupid. Why doesn't he do this? Or why doesn't he do that? That's one of the things that I love about the Dividend community here on YouTube and in general, right? There's many different ways that lead to success. Obviously, there's going to be some that are more historically proven to outperform others. But for me, this strategy, this approach works for me. And I'm aware that this is not going to be the approach that would be applicable to everyone. But for me, this is what I've done and what I intend to continue doing. All right, so let's take a look at some of the things that I've done. So over the last couple of weeks, I've sold out of a few different companies, and I want to share very briefly some of those investments that I've actually cut from my portfolio. So let's go over here to the next slide here. On May 6th, I made 2 sales. I sold out of both of my energy stocks. I sold out of ExxonMobil and Chevron. Now, with me selling out of them, it's not me saying that, okay, that these are overvalued or they're not going to perform well in the short term. Once again, this is the mindset that if I were to look 15 years into the future, they are very likely going to still, ExxonMobil and Chevron are very likely still going to be around. But what I don't want is, during those next 15 years and beyond, I don't want to constantly be thinking, okay, what's going to happen with the energy sector? I decided for myself that that's not something that I want to have in my portfolio. And so therefore, I've decided to take these out of my portfolio. They only made a very small portion of my portfolio, but that's the decision that I made with my 2 energy stocks. If we scroll down here, let's see. Let's go over to the next page here. On May 5th, I made 5 sales. I sold out of a few ETFs and a few individual holdings. Now, the ETFs that I sold out of, I really believe in these ETFs. I just want to consolidate and make my portfolio simple. SCHD is a great high dividend ETF. I want to put that out there. It's a really, really high quality ETF. SDY is a great high dividend ETF. DGRW, great dividend ETF. In terms of full disclosure, DGRW, my wife currently holds in her portfolio. She's still going to hold that. The reason why I sold out of SDY and DGRW was simply because of the expense ratio. For me, I believe that I can get a similar portfolio mix in my portfolio at a cheaper price. And that's the reason why I sold out of SDY and DGRW. The reason why I sold out of SCHD is because I'm consolidating and I'm going to be building up a larger position in the Vanguard High Dividend ETF in VYM. I also sold out of Ben and Cincinnati Financial. These are both great companies with great dividend histories. I ultimately decided to sell out of Ben and Cincinnati Financial simply because of the dividend growth rate and my investing time horizon. That's really the reason why I got out of them. And instead, what I've done, and I'll share this in a minute, is I'm consolidating into a sector-specific ETF in finance. So I'm lowering my exposure to finance. And I'm going to share that in a second. But once again, the 5 there, I still think that they're great investments. I'm consolidating my portfolio. The last company that I sold out of here was Southwest Airlines. Now, with Southwest Airlines, I think short term there's going to be some turbulence. But I think long term for me, I don't want to have in the back of my head, okay, is this the end of airlines? Are they going to be okay? Are they going to continue to grow? Right? I think the world has changed for airlines. I think long term, I'm confident that they will do well. For me personally, I just don't want to go to bed each night having that on my mind. I have enough going on. I have rental properties now. I want to live my life. I want to not have to worry about my portfolio. And this is one of the companies in my portfolio where, it could do well, it could also not do well. And for me personally, it just wasn't worth it to have it in there and have that in the back of my mind. So that's why I've decided to separate from Southwest Airlines. It's the only airline stock that I own in my portfolio. Those are the only sales that I've made here in the last months, right? And so those are the updates that I made to the portfolio. When you go back and we look at the dividends, my dividends are still coming in, right? They're coming in small amounts, whether they be 79 cents, $15, $2. These dividends are being used to repurchase in a drip fashion the other holdings in my portfolio. Okay. And so that's really, where I talk about on the channel is creating that snowball effect, and nothing has changed to that aspect of my portfolio. So those are the changes that I've made in terms of the holdings that I've sold. I've also bought into a few additional holdings. Now, for those of you that follow my channel, I've invested in M1 Finance very consistently. I've dollar cost average into the portfolio. As I mentioned, I have always, bought in consistently every single week in both my real estate portfolio and my dividend cash flow portfolio. And so over the last couple of weeks, what I've decided is I want to consolidate more. I want to have, previously, I've been investing into Vanguard index funds in my Vanguard account, and M1 Finance has been primarily been my individual company, like individual holdings, right? Here, I can go over here and I can show you the different holdings that I have in my portfolio. The large bulk of them have been individual companies like Microsoft, Texas Instruments, Ecolab, Kellogg's, individual companies, right? And the different holdings in my portfolio have performed differently, right? Wells Fargo is down, Travelers is down, International Paper is down, but I also have companies in there that are doing incredibly well. AbbVie, for example, Apple, Microsoft, and this is all relative to the price point that I bought them, right? So I have, the M1 has been pretty much my individual companies, individual holding portfolio. And now what I've decided to do is I want to, instead of investing more into Vanguard, into just index funds and have that separate, what I've decided to do is I want to incorporate more index funds into my M1 Finance portfolio, and then therefore increase my transfers into my M1 portfolio. Okay, so that's why I've updated my transfers now to $800. As with my new job, I'm in a sales position. As I get more commission, I will then be adding more on a weekly basis. But for now, I'm transferring over $800 a week into my cash flow portfolio, and that will increase as I continue to make more money in my rental income, as well as in my earned income from my active income. That's what I've decided to do there. So that's what I'm doing. And so how have I broken it up? Where is the target allocation set up? So what I have is the main fundamental change that I've done is I've added a slice here called Dividend Growth ETFs, and I've bumped that up to 50%. 50% of my holdings in my portfolio are going to this slice. And we'll dive into the individual slices here in a second. So 50% into dividend growth, 13% into my consumer staples, and the percentages here also reflect how many holdings I have into the portfolio. And I'm going to show just in a second how I have it broken down and kind of tie everything together. So 13 in consumer staples, 12 in industrials, 11 in technology, 5 in healthcare, 4 in consumer discretionary, 2 in utilities, 1 in financials, materials, and telecom. So I've taken out energy. All right, so with my dividend growth ETFs, I have 5 ETFs in here, and I've broken it down into 30, 30, 15, 15, and 10. With the top ETF being DGRO. I've had DGRO in here before. I just brought it over to this slice. VIG, the Vanguard Dividend Appreciation ETF, And the S&P 500 total market and the VYM, this was the replacement of the Schwab SEHD. So this is what I have in my portfolio. And in my Vanguard account, this is exactly what I had, right? And so what I've decided to do is I'm going to be adding more to my M1 portfolio and have everything a little bit more consolidated. So I'm not going back and forth between brokerages. I also like M1 a little bit better because I can dollar cost average into fractional shares into ETFs. I can do it in the my Vanguard account, but with index funds. And with that, it comes with a smaller expense ratio. It's not that big of a deal. But with M1, I can do it with ETFs. And that's something that I really like about that. So that's my top slice here with 50%. Consumer staples is at 13%. And this is one of the big changes that I've made. I've decided to consolidate and pick the companies that I want to invest heavier in. So for example, I'm investing more into Coca-Cola, or it's going to have a larger percentage of my overall portfolio. Kimberly-Clark, Pepsi, Procter & Gamble, and Walmart. These are my heavy hitters. These are the main companies that I want to focus on. And as I mentioned in previous videos, with changes in my own personal life where I'm having more things going on, I have less time to follow up on companies, this allows me to have a more targeted approach, a more condensed version of what I was doing before, and it allows me to follow up more on a smaller amount of companies while still maintaining proper diversification. In my definition of proper diversification, right? My definition may differ from yours. Okay, and so the remaining holdings in my portfolio have a very small allocation. And this may change as my situation change, right? Maybe once I reach retirement or once I have more time, maybe I have more time to follow up on these companies, and then I will be able to adjust the allocation. And I can do that very easily with M1 Finance. It's pretty cool. And so this is how I have it broken down, 2% in my remaining holdings. So essentially, I'm focusing on 5 companies here in the consumer staples slice, and those are going to be my main focus. If I go to my industrials, I'm doing something very similar. I have 3M, Waste Management, and Republic Services allocated the highest in my portfolio. The remaining companies in my industrial slice here are all allocated at 3%. I still think these are great companies. A lot of them are dividend kings, where they've increased their dividend for over 50 consecutive years. So I still want to keep them in the portfolio, but I want to have a more concentrated effort on my portfolio, where it's going to be difficult to follow up on 17 companies. It's not as difficult to follow up on 3 companies. And that's the approach that I've taken with this slice and overall with my entire portfolio. If you go down to technology, I have not made any changes to technology. I haven't made any changes to the other slices, by the way. I've just changed the target allocation. So with VGT, the technology sector is very difficult to determine who's going to be a winner in the future. Right now, Microsoft is a clear winner. Apple is a clear winner. It's very difficult. There's a lot of disruption. And so therefore, I've decided to have the highest allocation in this sector into a sector ETF in the Vanguard VGT. The second is going to be with Microsoft, Apple, and then Visa. These are my core positions: Microsoft, Apple, and Visa. These are going to belong into my core positions in my portfolio. If we go down to healthcare, healthcare is very similar. I have Johnson & Johnson allocated at 60%, BDX, MDT at 10%, and the remaining at 5%. There's a lot of great companies in here, right? A lot of these are great companies, but I want to focus on my core. My core is going to be Johnson & Johnson, in this case, in the healthcare sector. When looking at consumer discretionary, I'm focusing on McDonald's and Target. I have other companies in there: Nike, Marriott, Leggett & Platt, GBC, Darden Restaurants, and Disney also in here at a lower allocation. With Disney, I'm still a firm believer in Disney. They suspended their half-year dividend. I'm still going to be holding on to Disney. With my time frame, my investing time frame of 15 years, when I'm looking to reach financial freedom, financial independence, I'm not going to get there with my age just solely investing into Disney. I still think it's a great company. It belongs in the portfolio, but I'm going to be focusing on my core with McDonald's and Target for this sector. When looking at utilities, I'm focusing primarily on NextEra Energy. None of these companies are in my core portfolio. These are supplemental to my portfolio for proper diversification, but these are not in my core positions. I have 14 core positions, and I'll share that here in a second. I've not made really any changes to this other than I've increased NextEra Energy's target allocation. That's the only update that I've made. When looking at financials, here I made quite a drastic change here where I'm having 75% allocated to the Vanguard Financials Index. I think financials are going to do okay long term. I fast forward 15 years. I don't want to be losing sleep at night when I should be enjoying myself, right? I've reached financial independence. I don't want to have to worry, okay, are my investments going to cut their dividend? Am I going to have to go back to work? That's kind of the mindset that I have. And so I've lowered my risk in that sense, okay? And then materials, I have it fairly evenly distributed. Once again, these are also not in my core positions in my portfolio, at least for the time being. I have APD, Ecolab, and PPG as my, I guess you could say, core positions within this slice, but they're not core positions within my overall portfolio. Lastly, telecom. I've not made any changes to telecom other than the overall target allocation in my portfolio. So you got AT&T, Comcast, and Verizon, and I'm going to keep these. The reason why I have these 3 or 4, I guess you could say, lower, these are not growth sectors for the most part. Financials, utilities, materials, telecom, they're really not growth-oriented sectors. Energy as well, right? That's why I took out energy. I'm really doubling down on my 3 cores here, with that being consumer staples, industrials, and technology. Okay, so this is how I have it set up. And now let's take a look at how an ETF is set up. So this is where I think it's really, really interesting. If you were to go and just say, all right, Jake, well, why don't you just go and purchase the S&P 500? Okay, I mean, I could do that. I do invest in the S&P 500. I'm investing in the S&P 500 in my Roth 401k, my Roth IRA, right? I do have exposure there. If you look at the S&P 500 ETF from Vanguard, if you go to ETF.com and you scroll down and you take a look at what kind of holdings are in an ETF, right? An ETF, just a bundle of companies, a basket of different companies that are held into an index, and you purchase the index for a single price. That's what an ETF is, right? And so if you look at the holdings within the Vanguard S&P 500 ETF from VOO, you can see here the top weighted holdings equate to about 26%. You got Microsoft in there, you got Apple in here. These would be your core positions within this ETF. So if you're buying this ETF, these are the core positions of the ETF, but also there's a long tail. You're going to have other companies in here, but at a lower allocated target, right? So you're going to have exposure to AT&T, Pepsi, Netflix, Cisco, and then as you go on, you go further down here, right? You're going to have Caterpillar, a very small position in Caterpillar, right? And you go further down, right? We're not even halfway there, and we're already at 13%. So when you say you're invested in the total market or the S&P 500, yeah, but you look at eBay, you're hardly getting any exposure to eBay or FedEx or Kinder Morgan, right? Great companies, but you know what? They make a smaller portion of this index. And you go all the way down to the bottom here, and you're getting very marginal exposure, for example, to Discover Card, right? And other companies. A.O. Smith, right? Way down here towards the bottom, right? So this is how an ETF is set up. I have my portfolio set up in a very similar way. Let's take a look at how my portfolio would match if we were to look at the holding allocation. If we look at the holding allocation, my portfolio is set up in a very similar way, right? You have my ETFs here that make up 50% in the dividend growth slice. VGT equals to be just over 3%. But then this is where we get into the individual companies. My highest allocated company is Johnson & Johnson, Microsoft, 3M, and Waste Management. These are my top 5. If you go down here and you take a look at my top 10 holdings, right? These are my top 10 holdings. Johnson & Johnson, Microsoft, 3M, Waste Management, RSG, Apple, Coke, Kimberly, Pepsi, MCD. These are my top holdings. If you look at the allocation of my core holdings, we're just at around 25%. That is actually a coincidence. I didn't do that based off of this here. That is actually just a coincidence. If you look at my core holdings of here, let's take a look from Target all the way to Johnson & Johnson, my core 14 holdings, it's going to be at 30%. Okay, and so this is what I mean with core holdings. These are the companies that I'm going to follow up on. I have 85 holdings, 7 of those being dividend growth ETFs, the other being individual companies. My core holdings are just 14. The majority of my time is going to be spent on these 14 holdings right here. Okay, if you look at this, if you take the core holdings plus the ETFs up here, it's going to give us right around 84% of my portfolio is concentrated. And if we go down here, we also have a long tail in my portfolio, right? Where it falls off. I'm still getting exposure to Caterpillar, right? But I have a lower allocation, a lower percentage allocated to my portfolio in that. For example, we got Disney down here, we got Southern Company, and all of the companies, they're still in my portfolio. It's still acting like an index, and I have a little bit more control over my portfolio. And the cool thing about M1 Finance, if I wanted to go in and want to adjust these the percentages here, I could do it within seconds, right? And so this is how I'm going to have it set up here for 2020, and I'll reevaluate here next year, see where it's at, but that's how I have it set up. All right, now I want to go ahead and I want to walk everybody through the process of signing up to Propeller, right? Right now you have to request early access. They're still in beta, so you're going to have to request access. You're not going to necessarily get access to it right away. If you have multiple email addresses, hey, why not sign up with multiple email addresses? Maybe they do kind of like a raffle and they pull just random people. I don't know how the process works. I do have access to the platform. I'm not affiliated with them. I want to be very clear. I really am excited to talk about it. I'm using it and it's absolutely great, especially with using M1 Finance, because before they didn't have an integration, and I'm going to walk everybody through what that looks like. But to go ahead and sign up, just request early access, type in your email, and then you'll be on a waiting list. So when you're signing up, it's pretty straightforward. You go through that, and then once you're in there, you log into your account and you can request that you transfer over your portfolio, or you integrate your portfolio, which is pretty cool. You can do it through Vanguard. You can do it through Robinhood. I'm doing it through M1 Finance, okay? Once you log into your portfolio, you're going to pull up a dashboard like this. This is really cool. And as you know, I have 2 portfolios in my M1 Finance portfolio. I have my cash flow portfolio, and I also have my real estate portfolio. So you can see here the portfolio value, the portfolio yield, the next 12 months of dividend income. You can see what's already been declared and what is estimated. Really cool. You can see the graph here as well. You can click on the individual months. And for example, you can click here for June, for July. And if we click on June here, for example, and we click on details, you can see all of the information regarding the dividend payout. So the payout date, the amount, how many shares you have. It's just really cool. And it breaks it down also, right, by portfolio. So if you have multiple portfolios in there, you can manage them all within Propeller. Let's take a look at a few other things here. So one thing that I really want to highlight before I forget is the dividend yield. The dividend yield here, this is your yield on cost. This is how much you paid for the holdings. This is not necessarily what the portfolio is yielding based off the price or the value, but how much you're getting based off of your price point. If we go into the research tab in M1 Finance under my pie, under my cash flow portfolio, you can see what the portfolio is currently yielding. As of right now, this is not yield on cost. This is what the investments are yielding at today's prices. So just over 2.3%. So this is what the portfolio is yielding, but this is not what I paid for it. So this is the magic of compounding interest, right? You're not going to be getting the exact same yield on cost as the dividends are growing. Okay, and as you can see here, the portfolio yield is just under 3%, the yield on cost. All right, so let's take a look. Let's just focus here on the cash flow portfolio. You can see here the next payments. So 7 companies are going to be paying me dividends, and you can see exactly what they're going to be paying, right? So Intel, Schmuckers, Wells Fargo, etc. So these are the upcoming dividends that I'm going to be getting on June 1st, for example. So yeah, you got June, July. You can see here what's declared and what is estimated. It's kind of cool, right? And the thing that I love about this, it's all automated. I didn't have to build any charts for this. It's very simple. One thing that I do want to say though, it is just for desktop. There's not a mobile version of this, at least not yet. I'm hoping that they come out with a lighter version for mobile, but this is not for mobile. This is my favorite dividend tracker for mobile, is the stock dividend tracker. They have in-app purchases, but I don't purchase anything. I just do it for free and you can track it. It is a little bit cumbersome because you have to do it all manually, but you can also do it in fractional shares. Once again, not affiliated with them. I just use this for my mobile version. But now that Propeller is all automated on my desktop version, I probably will just be using Propeller going forward. All right, cool. So let's take a look at the portfolios, the portfolio tab here. So you can see, the two portfolios here. You can click on the portfolio. Okay, so you can see the portfolio here. You can see the summary of how many shares you have. This is really cool. The percentage of your portfolio as it stands today, right? With what we were seeing before, that is my target allocation. Right? So here, this is the actual value of my portfolio and how is that set up in my portfolio in terms of the percentage of the portfolio. So right now, currently AbbVie is my highest allocated portfolio. You can see the current dividend yield. You can see the annualized payout per share, right? This is how much you're actually getting paid. See if it's a stock or an ETF. Okay, let's take a look at the dividends here. So you can see the dividend yield. You can filter it by what is paying the highest dividend yield. You can see the payout ratio. This is your risk factor, right? If a company is at risk of cutting their dividend, this means they're paying more out to their shareholders in the form of a dividend than they're getting in revenue. So really, really scary. Likely that these companies cut their dividend. It's possible. Who knows? We'll have to see. The average annual dividend growth rate, right? The years of consecutive dividend growth, right? How many years have they been growing their dividend? You can see here the payout growth, right? How quickly are they growing their dividend and how frequently? Is it a monthly payer, quarterly, annual, etc.? You can see that with the payment date, how much it's going to be paying, how much per share. The ex-dividend is the last day that you need to have purchased the company in order to get the next dividend payment, right? The payment type, the status, if it's declared or estimated. Alrighty, everybody, that is the dividend tracker from Propeller from dividend.com. I think it's great. I'm going to be using this more frequently as I continue to track my dividend growth and my dividend progress. Thank you everybody so much for watching the video. We're just right around 7,000 subscribers. Thank you everybody for all of your support. If you're new to the channel, I'd invite you to subscribe. Help support the channel by liking the video. If you want to use Propeller, you can sign up on their website. Once again, not affiliated. I do have an affiliated link for M1 Finance. If you want to sign up to M1 Finance, you can use the link below. Thank you so much everybody for the support, and I will catch everybody in the next video.